Welcome to the Finance Garage podcast, your go-to podcast for navigating the world of finance. I'm Jonathan, your financial guide, bringing the latest market trends, investment strategies, and financial news that matters to you. And by the way, I'm also going to share my other passion, which is cars.
At the SWU Group, we help everyday families achieve financial success. Our integrated services include financial planning, accounting, credit advisory, and estate planning. We're here to guide and support you every step of the way, from custom investment strategies to maximizing tax efficiency. We ensure your financial goals are met with peace of mind. Visit simonwu.com.au for more information.
Hey everyone, welcome back to the Finance Garage. As always, Jonathan Wu, Senior Financial Advisor and Principal here at the SWU Group. So what's on my mind this month? This month I want to talk about young people and investing. A lot of young people are quite obsessed with the concept of investing, and I want to talk about why they shouldn't be. And if you are a young person listening, today is really all about you. I don't necessarily class myself as a young person anymore. Depends on, who I'm talking to. But, this is my 20th year in financial services and in financial advice. And so, there's a lot of people that I've helped, hundreds in my career, and I want to share with you a lot of those insights with regards to how people should think, especially young people, about investing and having a good mindset. I want to share, first of all, a story about someone I was friends with for many, many years. He's an incredible, intelligent person, and he came to me with this idea one day. We were catching up for dinner, I think, and he said, "Jono, I think I've got a way to basically retire and no longer have to live on earning a wage." I thought, oh, that's interesting. Tell me more. And he said, the focus is really about investing in the share market. I go, okay, share market, public markets, most people know how they work. And I always say to my clients and people, my friends and family, that always remember that investing is simple, but it's not easy. And what we mean by that is investing, i.e. opening up a CommSec account, NAB trade account, CMC markets, wherever, it's really easy. But actually investing for the long term, investing is actually the complex part. So this friend of mine said, I worked out that if I just trade shares full time, if I earn 0.5% a day, that would equate to earning 2.5% a week. If you then translate that to 4 weeks a month on average, then you'll get to 10%. And then if you multiply that by 12 to cover a year, you'll make 120% a year, not taking into account the impact of compounding. So I thought, that's interesting, because the key point was that I only need to make 0.5% per day consistently. That friend gave up his job to do that, and then 6 months later, he found a new job. Okay, so lesson learned, it is impossible to generate returns in a linear line. If that was the case, everyone would have retired. The other issue that I see with young people is that they go into investing and think, here's how I thought I would make my first $100,000, right? Because everyone targets that $100,000 threshold as their psychological, ideal number to say, I have saved this much money or I've achieved this much money, and therefore I can now have the capital to invest. The thought process is it would take several years to save $10,000, and then I would make one extremely good investment. And this investment would make 10x my $10,000 to make it $100,000, right? So this is the expectation, and you'd be really, really happy if you achieve that. The reality, though, is that it didn't happen. I did save my $10,000, but when I tried to invest it, and it turned into $100,000, I was sorely disappointed in the sense that it didn't turn into $100,000. After a year, an entire year in the stock market, it only grew by $1,200, which is the reality versus the expectation. Now, that was a 12% return. 12% return is actually really good. Yes, it is a far cry from the 10x, which is 1,000%, but the issue is that that's not reasonable. There are two takeaways, right? The first is to have a clear understanding of what reasonable returns are, because a reasonable expectation or reasonable return is not growing your capital by 10x or 1,000% within a year. Neither is also thinking that you'll double your money in a year. That's just simply not reasonable. Everyone knows Warren Buffett, who's probably the world's most famous investor, managed only 20% per annum from 1965 to 2021. And reality is that he didn't trade very much. Industry professionals or fund managers that we spend a lot of time on every year interviewing to find the best of breed ideas and strategies to blend within a diversified portfolio for our clients, their returns are considered decent if they manage to achieve more than 10% per annum over the long term. For the average person who doesn't actually invest full time, 5 to 8% is a more realistic number. Remember that all investments have risks, right? You won't be making money every year. This is the same expectation that I tell my clients. You could lose money in a certain year. Markets are volatile. Right now, we're in the midst of Trump's trade and tariff war, and that's caused a lot of volatility into markets. This doesn't mean the companies themselves have got any problems, but when the market lacks confidence, liquidity is sucked out of the system. So remember, Warren Buffett achieved 20% per annum, which is absolutely amazing. Industry professionals achieve around 10, which is fantastic, and the average person should expect that it's somewhere between 5 to 8. The second lesson to be learned out of this is that many people link the concept of personal finance or wealth very strongly with the concept of investing. And then they think to themselves, why don't I become a full-time investor? It doesn't end up working very well for them, or doesn't work out well for them. So why is that?
Ready to take the first step in investing, or just looking to continue growing your wealth without being inundated with financial information? With SWU Online Invest, we offer a range of expertly managed portfolios designed to match your investment needs. Whether you're a seasoned investor or just getting started, know that we will work tirelessly to ensure your investments are strategically positioned to maximize your goals. Visit swuonlineinvest.com.au today.
Well, the first thing is the concept that I start off with at the beginning. Investing won't earn you a lot at the start. Let's use $10,000 as the example, right? So you're holding $10,000 as your investable capital. And if you make 7% in the first year, you'll attract $700 worth of returns. Now, I'm not even including the impact of tax, right? In Australia, we have a very complex and, marginal tax rate system that can also sap away your wealth. And this is why I always say to clients, before you even consider trying to get the maximum return, think about the structure that you're using or which part of the tax spectrum you are using in order to maximize your return on an after-tax basis. I'll cover that later in a different episode. But if you come back to the main point, when your capital is small, then your returns are also going to be small. Most of us don't start off with $100,000 or $1 million in life. So at this stage, your efforts are best served by increasing your capital base. So the question is, how do we increase the capital? Well, if you're in the workforce, then you work on your earning power. Instead of focusing on picking stocks, which you simply don't have the time for, consider learning in-demand skills, negotiating for an increment, or doing a side hustle. Those things would add up more because, going back to that same theory, you might negotiate a salary that increases your salary income by $4,000 a year. You start a high side hustle that gives you an extra $4,000 a year. You might look to change jobs and get a better paying job, and that pays you an extra $12,000 a year. And you then compare that against your investment returns of $700 a year and go, oh, so my labor, my ability to earn money through wages is obviously more powerful than investing. Of course it is, because investing is a passive form of wealth creation. It is there to supplement your wage earning capacity. Because once you improve your income, you will have more capital and your investment returns will naturally increase as well. So instead of originally having $10,000 in the market earning you 7%, which is $700, you have $100,000 in the market earning 7%, which is $7,000. And it compounds. If you talk to family and friends or other investors, they all talk about the struggle to get to the first 100K. After the first 100K, everything starts to snowball. And once you do this long enough for investments, your investments will indeed make you wealthy, because going from 10,000 to 100,000 and the 100,000 becomes $1 million at 7% is $70,000 a year. So what's the actionable steps you should take with this information? Well, first and foremost, forget about getting into a get-rich-quick scheme. They don't exist, right? Even if it does, it often leads people taking too much risk and leading to financial setbacks. This is something that I equate to a lot in the crypto world, where a lot of the things are quite opaque and you could go, in many situations, end up in a very binary outcome, which is no different from going to the casino, betting on red or black. It's a 1 or 0 binary outcome. You either double your money or you lose everything. The second thing to remember is invest early with realistic expectations, right? Don't get me wrong, investing is still important, but just remember it won't be the main driver of your wealth from 0 to $100,000 or even $1 million, right? But every bit does count towards an end goal. In the same way, tax cuts could be coming down the barrel again, and you save $50 a week, and you look to yourself and go, $50 a week, what's that? Every bit counts. $50 a week is equivalent to what? Probably 8 coffees at today's prices, right? A week, that's 8 coffees. That's a coffee a day. It's worthwhile. The third lesson is work on your earning power. There is, at the end of the day, as I mentioned, no substitute for having a good network and in-demand soft and hard skills. Let's take a closer look at how all of these 3 concepts interplay with each other. You have hard skills, which are the technical skills to your specific industry, right? So some examples include software proficiency, coding ability. You may have foreign language skills that others don't have. You might be good at SEO marketing or other professional certifications. These things increase your technical skill. You then complement that with soft skills, otherwise known as EQ or emotional quotient, as opposed to the IQ part. And these are non-technical skills that will enhance, in my opinion, probably more greatly than IQ, in your ability to basically generate more wealth. Some of these soft skills include communication, teamwork, problem solving, time management, critical thinking, and empathy. And finally, having a good network will connect your soft skills and hard skills with people who are just simply willing to pay more for them. So don't ignore this critical juncture in your life, especially when you're young, to explore these things and not simply just trying to get into a get-rich-quick scheme, which I can tell you after 20 years, I have looked and still have not found it. Remember that you yourself are the best investment you can make. With that, always happy to take feedback on at jonathan.wu@simonwu.com.au if there's more other topics that you'd like me to discuss on the show. As always, remember to listen to the disclaimer at the end. Until next time, we'll speak soon. See ya.
This podcast is not financial product advice and is intended to provide information only. It does not take into account the investment objectives, financial situation, or needs of any person. You should assess whether the information is appropriate for you and consider talking to a financial advisor before making any investment decisions. Any investment examples are for illustrative purposes only. The information is taken from sources which are believed to be accurate, but Simon Wu, Jonathan Wu, SWU Financial Planning, and Personal Financial Services Limited accept no liability of any kind to any person who relies on the information contained in the podcast. Unless expressly stated, none of the information should be taken as a recommendation. For more information, please visit www.simonwu.com.au.